The Canadian economy, already contending with inflation, tariffs, and a cost of living crisis, is also watching a steady and ongoing slump in the housing market.
When it comes to home ownership in this country, our next guest says there have been several tipping points over the years.
I am Emma Reporter, and you're watching CA Reporter. Tonight, we need to talk about what's really happening in our country. Not the spin, not the political talking points. The reality on our streets, in our homes, and inside our bank accounts. Because across Canada, from the GTA to the Lower Mainland, families are being squeezed in a way we haven't seen in decades. The Bank of Canada's policy rate is sitting at 2.25% as of early 2026. On paper, that sounds stable. Inflation has eased to 2.3% in the latest January and February data. Those numbers look calm. They look controlled. But when we step outside the spreadsheets and look at our actual mortgage statements, we're seeing something very different. Over the past 2 years, hundreds of thousands of us renewed mortgages that were locked in at rock-bottom pandemic rates. Back then, we were paying 1.5%, maybe 2%. Now, many of us are renewing closer to 4, 5, even higher, depending on our lender and term. That jump is not theoretical. It's real. It's hundreds, sometimes thousands of dollars more every single month. And here's where it gets serious. In Toronto, mortgage arrears have quadrupled from their post-pandemic lows. Quadrupled. That means 4 times as many households are now falling behind on their mortgage payments compared to just a few years ago. These are not reckless borrowers. These are working families, nurses, tradespeople, office workers, small business owners. We were told that as inflation cooled, pressure would ease. And yes, the headline inflation number is down, but our costs haven't magically reset. Grocery prices remain elevated compared to 2020 levels. Insurance premiums are up. Property taxes are rising in major municipalities. Condo fees are climbing. And even though the federal government canceled the consumer carbon tax in April 2025, the industrial carbon tax has risen to $110 per ton in 2026. That cost flows through supply chains. We feel it in food, transportation, and building materials. So what's happening is simple but brutal. Our incomes have not kept pace with the cost of owning a home at today's rates. When we combine higher renewal payments with elevated living costs, our monthly budgets are cracking. In the GTA, we're hearing from families who bought modest detached homes in 2020 for $800,000 or $900,000. At the time, their payments were manageable. Today, after renewal, some are facing increases of $800 to $1,500 per month. That's not a minor adjustment. That's the difference between saving for our kids' education and draining our RRSPs just to stay afloat. And it's not just Toronto. Vancouver's Lower Mainland is seeing similar stress. Calgary and Edmonton, while more affordable historically, are now dealing with rapid price growth that has stretched new buyers to the limit. We need to be honest with ourselves. This isn't just a housing story, it's a debt story. Canadians carry some of the highest household debt levels in the G7. For years, low interest rates masked the risk. Now that mask is coming off. What we're witnessing right now is the aftershock of a decade of ultra-low borrowing costs, colliding with a reality that has changed. For years, we were encouraged to believe that rates would stay low for the long haul. Cheap credit-fueled bidding wars across the GTA pushed townhomes in the Lower Mainland past the $1 million mark and turned detached homes in mid-sized cities into high-stakes investments. We were told housing was safe, that it only goes up, that leverage was manageable. But here's what the data tells us today. With the Bank of Canada's policy rate at 2.25%, we're no longer in emergency territory, but we're also not back in the rock-bottom era that many of us built our financial lives around. Even if rates are lower than the peak tightening cycle, renewals are still landing far above pandemic levels. That gap is where the crisis lives. Mortgage stress doesn't happen overnight. It creeps in. First, we cut back on discretionary spending. Fewer dinners out. No summer trip to Muskoka. We delay replacing the car. Then we start leaning on credit. Lines of credit, credit cards. We tell ourselves it's temporary, but when renewal hits and our payment jumps by $1,000 a month, temporary becomes structural. In Toronto, where arrears have quadrupled from post-pandemic lows, lenders are reporting rising delinquencies, particularly among variable rate borrowers who stretch their amortizations during the rate hikes. Many of us saw our amortization periods balloon beyond 30 years just to keep payments steady. Now, at renewal, that reset is forcing payments higher. There's no more room to stretch. And let's talk about income. Wages in Canada have grown, but not nearly at the pace of housing costs over the past decade. Even with inflation easing to 2.3%, the price base remains elevated. We are paying more for food than we were 3 years ago, more for rent, more for property maintenance. The cancellation of the consumer carbon tax in April 2025 provided relief at the pump and on heating bills, yes. But the industrial carbon price at $110 per ton in 2026 continues to ripple through production and transportation costs. Businesses pass those expenses along. We feel it quietly, line by line, on our receipts. The pressure is especially intense for younger families. Many bought at peak prices between 2021 and 2023. Some put down the minimum 5 or 10%. Now, if home values soften in certain pockets, equity cushions shrink. That creates psychological stress on top of financial strain. We don't just worry about making payments. We worry about being trapped. And let's be clear, this is not just about homeowners. Renters are caught in the same storm. Landlords facing higher mortgage costs often try to raise rents where regulations allow. New builds carry higher financing expenses. Those costs get embedded into rental pricing. So whether we own or rent, the weight is shared. We are entering a period where financial resilience matters more than ever. But resilience is hard when our margins are razor thin. When one job loss, one illness, one unexpected repair can push a household from stable to scrambling in a matter of weeks. There's another layer to this crisis that we need to confront, and it's confidence. Housing in Canada has never just been about shelter. For many of us, it's our retirement plan. It's the asset we counted on to fund our later years, to help our kids with down payments, to create stability. When that foundation feels shaky, the emotional toll spreads fast. In parts of the GTA, sales volumes have slowed compared to the frenzy years. In the Lower Mainland, listings have climbed in certain segments as owners test the market. We're not looking at a nationwide collapse, but we are seeing strain. When arrears quadruple from post-pandemic lows in Toronto, that's not noise. That's a warning sign. It tells us more households are hitting a wall, and here's what makes it more complicated. Canada's population has grown rapidly in recent years, increasing demand for housing. At the same time, construction costs remain elevated compared to pre-2020 levels. Even though inflation is now at 2.3%, builders are still dealing with higher material and labor costs baked in from previous spikes. The industrial carbon price at $110 per ton in 2026 also affects cement, steel, and transportation. Those costs don't disappear. They become part of the price of every new home and condo. So we have a system where supply is constrained, demand is high, and financing is expensive relative to the ultra-cheap era we just left. That combination creates pressure from both directions. Buyers can't comfortably afford today's prices at current mortgage rates, yet prices don't fall dramatically because demand remains strong and inventory is limited. For many of us, the most immediate impact is cash flow. A family earning a combined household income of $120,000 in Ontario may have qualified comfortably at pandemic rates. But at renewal, with payments up by $1,000 a month, that same family might now be allocating well over 40% of take-home pay to housing. Financial planners have long warned that once we cross that threshold, vulnerability rises sharply. We're also seeing an increase in secondary effects. Consumers are cutting discretionary spending, which affects local businesses. Home renovations are being postponed. Big-ticket purchases are delayed. When thousands of households tighten simultaneously, economic momentum slows, even with the Bank of Canada holding the policy rate at 2.25%, Broader confidence influences spending decisions, and we can't ignore regional disparities. Alberta's markets, while historically more affordable, have experienced price growth that stretches first-time buyers. Atlantic Canada, once seen as a haven of lower costs, has also seen significant appreciation. There is no simple safe zone anymore. We have to ask ourselves a hard question. Did we build an economy too dependent on ever-rising home values? When so much of our household wealth is tied to property, any shift in rates or lending conditions reverberates nationally. This moment is not about panic. It's about realism. We need transparency from policymakers. We need responsible lending, and we need honest conversations about affordability, not just slogans. Because right now, too many of us are lying awake at night doing math in our heads, wondering how long we can keep this up. What happens next depends on decisions made in boardrooms, in Ottawa, and in our own kitchens. The Bank of Canada holding the policy rate at 2.25% signals stability for now, but stability does not erase the shock many of us already absorbed at renewal. Even if rates stay where they are, we are still carrying payments that are dramatically higher than what we signed up for during the pandemic years. For families already in arrears, the options narrow quickly. Lenders may offer temporary extensions, refinancing, or in some cases, longer amortizations. But those measures often mean paying more interest over time. For households without savings buffers, selling becomes the last line of defense. And when more listings hit the market from distressed sellers, that can shift local pricing dynamics, especially in highly leveraged neighborhoods. At the same time, inflation easing to 2.3% provides some breathing room in theory, but we have to remember that lower inflation does not mean lower prices. It simply means prices are rising more slowly. The grocery bill that climbed sharply between 2021 and 2024 hasn't rolled back. Insurance premiums have not reset. Municipal budgets are still under pressure, and property taxes continue to edge upward in major cities. We feel that every quarter, the cancellation of the consumer carbon tax in April 2025 reduced direct household charges on fuel and home heating. That mattered. But with the industrial carbon price at $110 per ton in 2026, cost pressures remain embedded in production and transport. We are still paying indirectly. For many of us, the relief on one line item is offset by increases elsewhere. We also need to confront the broader debt picture. Canadian households remain among the most indebted in the G7. When rates were near historic lows, debt servicing ratios looked manageable. Now, even at 2.25% policy rates, the average effective mortgage rate for renewing borrowers is significantly higher than it was 5 years ago. That difference is what's straining budgets. There is no single villain here, not one policy, not one decision. This is the cumulative effect of years of cheap credit, rapid price growth, limited housing supply, and global inflation shocks. But acknowledging complexity does not make the pain any less real for families choosing between mortgage payments and rebuilding savings. We have to demand practical solutions, accelerated housing supply approvals, responsible immigration planning aligned with infrastructure, financial literacy that prepares borrowers for rate cycles, not just low-rate optimism, and above all, transparency. We deserve clear data, clear communication, and policies grounded in evidence from Statistics Canada and official federal reporting. Because this is our country. These are our homes. These are our futures tied up in monthly payments that feel heavier than ever. I want to hear from you in the comments. How is this affecting your family? And if you believe in independent, fact-based reporting for Canadian residents and taxpayers, make sure you subscribe to CA Reporter so we can keep digging into the stories that matter to all of us.